Welcome to FXtech's comprehensive USD CAD analysis for November 17th to 22nd, 2025. This week, the US dollar against the Canadian dollar tested the critical 1.4100 resistance level, creating a pivotal moment for traders across all timeframes. We'll examine the key technical levels, fundamental drivers including strong NFP data and falling oil prices, and provide actionable trading strategies for day traders, swing traders, and position traders. Our analysis draws from TradingView, Investing Live, Action Forex, Forex.com, and Daily Forex to give you a complete market picture. Whether you're looking for short-term scalping opportunities or building long-term positions, this report will equip you with the insights needed to navigate this critical juncture. Let's dive into the analysis. USD/CAD closed at 1.41038 on November 22nd, marking a weekly gain of 0.52%. The pair is currently testing the critical 1.41049 resistance level, which represents a significant swing area from earlier in November. Technical indicators show a mixed picture. The RSI stands at 56, suggesting neutral momentum, while moving averages are strongly bullish with 13 out of 13 showing buy signals. The 50-day EMA crossed above the 200-day EMA in mid-October, forming a golden cross that supports the long-term bullish case. Price action has been characterized by clearly defined ceilings and floors, with 1.4079 acting as the short-term support and 1.41049 as immediate resistance. This tight-range trading reflects market indecision as traders await the next catalyst. Two major fundamental factors drove USD/CAD higher this week. First, the November 20th U.S. non-farm payrolls report showed strong job creation, reducing expectations for aggressive Federal Reserve rate cuts and supporting the U.S. dollar. This data reinforced the narrative that the U.S. economy remains resilient despite higher interest rates. Second, crude oil prices fell 2.72% during the week, undermining the Canadian dollar, which is heavily correlated with energy prices. Canada's economy depends significantly on oil exports, so weakness in crude directly translates to CAD weakness. Additionally, the interest rate differential between the U.S. and Canada continues to favor the USD, creating a positive carry trade where investors earn interest by holding long USD over CAD positions. These structural factors provide ongoing support for the pair. USD/CAD benefits from a robust, multi-layered support structure that provides downside protection. Immediate support begins at 1.4079. The short-term floor that previously acted as resistance. Below that, 1.4011 marks the November monthly open, a psychological level that often attracts buyers. The major psychological zone of 1.4000 to 1.4007 is backed by the 50-day EMA at 1.3960, creating a strong defensive cluster. Critical medium-term support sits at 1.3970, last week's low, which represents a key pivot for maintaining the bullish outlook. The most important strategic support is 1.3886, which determines the medium-term bias. A sustained break below this level would invalidate the bullish case and suggest the uptrend from 1.2005 has completed. The 200-day moving average at 1.3928 provides additional long-term support. The path higher faces several well-defined resistance zones. Immediate resistance sits at 1.41049, the current ceiling that has capped recent advances. Just above, the confluent zone of 1.4104 to 1.4109 represents a critical breakout level, combining the 78.6% retracement of the monthly range, November's high day close, and a 75% parallel convergence. A daily close above 1.4109 would confirm the breakout and target the next resistance cluster. Medium-term targets include 1.4139 to 1.4141, November's swing high, followed by 1.4167 to 1.4178, which marks the 50% yearly retracement and 2024's November high. The primary medium-term target is 1.4312, the 61.8% Fibonacci retracement that would complete Elliott Wave B of the corrective structure. Long-term targets extend to 1.4500, the 9-year high, 1.4791, the previous 2025 high, and ultimately 1.5000, a psychological milestone not reached since the early 2000s. For the next 1 to 2 weeks, USD/CAD is expected to remain range-bound between 1.4079 and 1.41049, with a neutral to mildly bullish bias. The pair has been trading up and down with clearly defined ceilings and floors, creating excellent conditions for range traders. The key catalyst will be whether bulls can achieve a sustained break above 1.4109, which would open the door to 1.4141 and potentially 1.4250. Conversely, failure to break higher and a move below 1.4040 would shift momentum back to the bears, targeting 1.4000 and potentially 1.3970. Day traders should focus on buying near 1.4080 and selling near 1.4100, with tight stops of 15 to 20 pips and targets of 30 to 50 pips. Monitor key economic data releases, Federal Reserve speakers, and oil price movements, as these will provide the next directional impulse. The medium-term outlook for the next 1 to 3 months suggests range trading between 1.3886 and 1.4312. This aligns with the Elliott Wave analysis, which indicates USD CAD is in Wave B of a 3-wave A-B-C correction within the larger uptrend from 1.2005. Wave A saw a decline from 1.4791 to 1.3538, and Wave B is the current rally that should reach 1.4312, the 61.8% Fibonacci retracement. After completing Wave B, Wave C should see another decline toward the 1.3800 to 1.3900 area before the primary uptrend resumes. Swing traders should look to buy dips toward 1.3886 to 1.3950, with stops below 1.3850 and targets at 1.4250 to 1.4312. Conversely, sell rallies toward 1.4250 to 1.4312, with stops above 1.4350 and targets back at 1.3886 to 1.3950. This range-bound environment favors scaling in and out of positions at the extremes rather than chasing breakouts. The long-term outlook for 3 to 6 months and beyond remains constructive, supported by the Golden Cross formation, where the 50-day EMA crossed above the 200-day EMA in mid-October. Historically, Golden Crosses lead to 5 to 10% gains over 6 to 12 months, suggesting potential targets of 1.4500 to 1.5000. The broader uptrend from the 2021 low of 1.2005 and the 2007 low of 0.90567 remains intact. Structural factors supporting USD/CAD include U.S. oil production of 12 million barrels per day, which reduces Canada's export advantage. Canada's 75 to 80% trade dependence on the U.S., creating persistent USD demand. Positive carry trade benefits from interest rate differentials, and favorable U.S. demographics. However, warning signs include bearish MACD divergence on the monthly chart and the risk that the 5-wave structure from 1.2005 completed at 1.4791. The critical long-term support is 1.3562, the 55-month EMA. Sustained trading below this level would invalidate the bullish case. Different trading styles require different approaches to USD/CAD. Day traders should focus on the 1.4079 to 1.41049 range, buying near 1.4080 to 1.4085 and selling near 1.4100 to 1.4105, with tight 15 to 20 pip stops and 30 to 50 pip profit targets. Use 5-minute and 15-minute charts, monitor NFP and Fed speakers closely, and exit before major news events. Avoid overnight holds. Swing traders should build long positions at 1.3886 to 1.3950 with stops below 1.3850 and targets at 1.4250 to 1.4312, or short positions at 1.4139 to 1.4178 with stops above 1.4200 and targets at 1.4000 to 1.3970. Use 4-hour and daily charts, scale in and out at key levels, and trail stops after achieving 50% of your profit target. Position traders should build core long positions at 1.3886 to 1.3950 in 3 to 4 tranches with stops below 1.3562 and targets at 1.4500, 1.4791, and 1.5000. Universal risk management principles apply to all styles. Never risk more than 2% per trade. Limit total portfolio risk to 6 to 8%. Always use stop losses and avoid correlated positions. USD/CAD stands at a critical juncture where the 1.4100 level will determine the next major move. Short-term traders should focus on the 1.4079 to 1.41049 range, waiting for a clear breakout above 1.4109 to target 1.4141 to 1.4250. Medium-term traders should prepare for range trading between 1.3886 and 1.4312, buying dips and selling rallies. Long-term position traders can maintain core long positions targeting 1.4500 to 1.5000 with the golden cross and structural factors supporting the bullish case. Bullish factors include strong NFP data, crude oil weakness, positive carry trade, and Canada's trade dependence on the U.S. Bearish risks include strong resistance at 1.4104 to 1.4109, potential oil price recovery, Fed pivot risk, and bearish MACD divergence. Critical levels to watch: resistance at 1.4109, 1.4312, and 1.4500. Support at 1.4079, 1.3886, and 1.3562. Remember, the market rewards patience and punishes impatience. Wait for clear setups, use proper position sizing, always employ stop losses, and trade the chart, not your emotions. Thank you for watching, and good luck with your trading.